Again, my apologies. You guys are nicer than me, man. If someone had made me wait for half an hour, I'd been like, maybe you were cursing me before I got on here. But anyway, I really am sorry. It was an honest mistake, but it was still a mistake. Okay, so let's take a look at a few things here. I know that you guys have probably already looked at the study guide a little bit, but I wanted to talk through a couple points on it that I think might be valuable, and then we'll try to maybe do some specific examples. So I am looking for modules. And then exam. There we go. All right, let me share my screen with you now. Okay. All right, like I said, I know that you guys have already probably looked at this and studied it on your own, but I just, there's a couple of things I wanted to maybe point out on here. And actually one general thing too. So as I've been reviewing exams, the last several exams, I think people are missing as many questions because they're not reading the question carefully as they are missing them because they don't understand the concepts that they're dealing with. And so they're missing like important little pieces of, you know, I guess little context clues that would tell them more than they are really not understanding the accounting part of it. So I would just like to reiterate, like, carefully reading the question, even if you have to use a piece of note paper to say, okay, what are they asking me for, and what information is given to me, and then starting from there, because I feel like a lot of times, you know, it's easy to miss those things. So I know the last time I talked with a group of folks, they were like, I wish there was a summary of these new accounts and their classifications and normal balances since the last exam. I found a document that actually comes from the textbook publisher that does that, and I've added that to my additional study resources document down at the bottom. So like, I'll show you where that is because it's a really valuable tool. If you go in the modules and you scroll all the way down, oh, come on. And there's student resources, and you click on additional study content. At the very bottom of that, there is this account classification review that comes from Wiley Plus. And in essence, what it breaks down is like every account that we've talked about in the class. And so that can be helpful as you're trying to figure out what new accounts am I dealing with. The unfortunate thing about this is it doesn't have it like in order, like by chapter. It just has them in alphabetical order. But then the second one, sorry, my Zoom thing is in the way here and I can't see what I'm doing. The second one this chapter content rapid review from Wiley Plus. It has, make that a little bigger. It's a PDF and it breaks it down by chapter, all of the kind of new stuff and summaries of each chapter, which can be really helpful. So I just want to show you those resources because last time we talked about things, a couple people were like, oh, I wish I knew which accounts I'm dealing with in each chapter. And so between those two resources, it kind of has all the accounts we deal with and then the summary of the new stuff from each chapter. So I think that can be helpful. All right. So let me see, what were the other things that I thought really jumped out as far as like there were multiple questions on the exam. This know how to make journal entries for payroll, include knowing which items are deductions and which are withheld from earnings. So I see students over and over sort of getting hung up on that concept of some parts of payroll are withholdings from the employee. So they're not an expense to the employer, they're just a withholding, and you pull them out of the employee's paycheck and then put them as a payable, and then you pay them when the time comes, versus those other, like the employer's half of OASDI and Medicare, and then federal unemployment or state unemployment, which are expenses to the employer. So that is an area where I see people get hung up, and this being able to make some payroll entries actually accounts for several questions. So I'd like to make sure you're comfortable with that. The concept of bonds being issued at a premium or a discount. So they want you first of all to recognize when a bond is issued at 99, that means it's issued at 99% of its face value. And then if it's issued at 101.5, for example, that's issued at 101% of its face value. So knowing what that means, right? A bond issued at 100 is at its face value, 100% of its face value. And you'll see in the review here, it's be able to determine if a bond sells for a premium or a discount, comparing the market rate and the contractor stated rate of interest. So there's several of these line items that all have to do with bonds. And so if you're feeling shaky on bonds, that's an area you have to kind of get buttoned down. And I'd be happy to go over anything if you want me to on that too. And then be able to journalize the issue of sale bonds at face value, compute and journalize interest payments on a bond. This is an area where people at this stage kind of continually miss recognizing that bond interest there has to be an adjusting entry at the end of the year to show any bond interest from the time the bond was issued to the end of the year, and then another entry when the bond actually becomes mature. That seems to get people a lot. And then let's see, I think those are the biggies that I feel like they hit several questions that getting comfortable with those will make a big difference in your grade. Again, if you have questions, jump in or put them in the chat. You don't have to wait till I'm done talking. Again, I'm just going over the biggies, but there might be something in here where you're like, I feel really weak on this, and then we can address it. All right, so chapter 11 gets into equity, right? So like things like stocks and the difference between common stock and preferred stock and par value stock or stated value stock, all of those things. So you kind of have to really know the difference between all those terms on the exam. Okay, there's going to be several questions that are terminology based in the chapter 11 questions. Does everybody feel okay with these? Does everybody like me to try to explain any of these specific terms?
Yeah, go ahead.
Well, which one? All of them?
Yeah, all of them. Go for it.
that might take all of our time.
Oh.
Well, so I'll tell you the ones that I think recognizing the difference between preferred stock and common stock matters because preferred stockholders don't have voting rights. They don't get to vote for like the board. They do usually have a stated amount of interest that they'll earn for dividends. And knowing that preferred stock will get its dividend payments before the common stock will. I think those matter. And recognizing that many preferred stock often has what's called cumulative dividends, meaning if the company can't afford to pay dividends in 1 year, then it has to make up those cumulative dividends from previous years on the preferred stock before it can pay out anything to the common stockholders. So knowing those things, I think are hits many of those points. Let's see. I think the calculations on shares outstanding of common stock get people, because they miss that Treasury stock subtracts outstanding shares. And so there'll be some, and a lot of times people miss how to start with the process. So it'll tell you something like you have $1 million worth of $4 par common stock. And so people are always like, well, I don't know how many shares I have. And that's what you have to do to figure out outstanding shares. So recognize that if you have $1 million worth of $4 par stock, then you can take $1 million divided by $4. And it will tell you there's 250,000 shares of stock out. And then maybe it'll say something like there's 5,000 shares of Treasury stock. So you'd subtract those out, and you'd have 245,000 shares. So being able to calculate the number of shares based on the dollar value of the stock and the par value of the stock together, and then being able to add shares in when more are issued and subtract them out as they're brought into Treasury stock, that's an important skill to be able to do for this chapter. So Treasury stock, again, just from a definitional standpoint, that is stock that's already outstanding. It's out there being traded on the secondary market that a company buys back in and holds in the company. Most often companies buy Treasury stock for the purpose of having shares available for their employees' stock ownership plans, things like that. But those shares of Treasury stock are not on the market for other people to buy. So we subtract them from the number of outstanding shares. Let's see. I mentioned the idea of dividends and arrears on cumulative preferred stock. That's just another term. That means what I mentioned earlier, where if the stock didn't pay dividends in previous years and the preferred stock is cumulative, that means that the preferred stockholders have a right to any arrears or dividends from the past. Okay. That means if the company decides to declare a dividend this year, they'll have to pay the cumulative preferred stock dividends first before they can pay any of that to common stockholders.
So preferred stock, people who have preferred stock always get paid first.
Right. So so what'll happen is the board of directors will declare usually like a certain dollar amount of dividend. We're going to pay, $10 million in dividend this year. So what you do is you calculate how much dividend is owed to preferred stockholders, and you allot, that first, and then anything left over gets divided up among the common stockholders. Let's see. Stock splits, we've probably all heard of those. A stock split is when they actually reduce or cut the market price of a stock. If it's a 2-for-1 split, that means they cut it for half, and it also not only reduces the market price, but the par value of the stock, but then the number of shares is doubled. So this happens a lot when some companies just will make decisions that they don't want their stock price to be too high. And so they'll do a stock split to reduce the cost or the price of that stock, but then everybody has twice as many shares. So everybody ends up with the same value of that. Let's see.
I thought the par value didn't have any effect on the market.
Yeah, so it doesn't. Okay, so par value really is a weird thing. So par value is really pretty arbitrary. It's just assigned in the corporate charter. But whenever somebody does a stock split, they still split the par value as well as splitting the market value. But it's
Okay.
not that there's a relationship per se between the market value and the par value.
Gotcha.
It's just that when you issue your charter, you say we're going to issue this many shares of stock at this amount par. So if we split it, now we're going to have twice as many shares available out there, but at half the par value.
Okay.
I met a lady in Texas who told me, I knocked on her door. I was working for Edward Jones Investments and just gave her my card, said I do investing. And she told me her husband had once bought some Coca-Cola stock and he had it in a shoebox in the back bedroom. And their husband had died. I said, what year did you buy that stock? She said, 1950. And I said, you just have it in a shoebox? You don't have an electronic account somewhere? And she said, no, we don't need electronic accounts. So normally what happens in the old days is when your stock would split, the company, the transfer agent for the Coca-Cola, it'd be some bank or brokerage firm, would send you a new certificate with, say, if she had 200 shares, and the new certificate would say 400 shares, and it would cancel your old certificate. But they'd moved several times in the military, and the transfer agent had lost contact with them. So their stock had been having these splits, and the transfer agent has to keep track of that, but they didn't have an updated certificate. And from 1950 to 2001, I think is when I met her, Coca-Cola had split enough times that after I did the math, she had like 22,700 shares of Coca-Cola. And it was like, I'm trying to remember, the market price at the time was over $1 million worth, and sitting in a shoebox in her bedroom. And I thought, man, she didn't have any kids. I told her she could adopt me, but she started a scholarship fund for the local kids. Anyway.
And those were still good, even though they were just sitting there.
Yeah. Once we contact the transfer agent and show, proof of they were in her husband's name, so she had to show a death certificate and those sorts of things. But they issued her, they don't usually issue paper certificates anymore. They just create an electronic account, but you can still get paper certificates if you want. Anyway, so stock splits can really impact over a long period of time, because what would happen is that Coca-Cola would rise up to $100 a share, then they'd split it and it'd be $50 a share, but instead of having 200, she had 400, and then it would grow again, and then they did a 3-for-1 split, and she just ended up with a bunch of shares. So it was kind of cool.
I used to work with a guy who was, gosh, he's got to be close to 80 now. He's about the same age as my dad. And in high school, they had an economics class where they did a penny stock type purchase his senior year. So he bought a couple dollars worth or whatever it was in the early 1960s of Texas Instruments, before before personal calculators were really a thing, and threw it in a drawer. And his mom passed away, 20 years ago, 15 years ago, somewhere in there. He was cleaning out the attic and found his old, childhood desk and opened the drawer, and the stock certificate was still in there. It was an original, issue of I think Texas Instruments went, IPO or whatever they called it in those days in 1961. And it ended up, cash out value, I think he ended up with about $5.8 million. And, retired from the military. He was in his, he was, doing kind of post-retirement work in the telecommunications industry. And so he and his wife bought a place, out in the boonies somewhere, and just living as large as they choose to live at this point. But I love that story because he was such a cool guy and had done so many cool things in his life. And the last couple decades, he's not had to worry about a thing. So
yeah, that's insane, actually, when you think about it. Not as insane as, say, like a big ship getting stuck in the Suez Canal, but
right.
almost. Anyway,
There's got to be a little bit of stunt. I'm not trying to be a conspiracy theorist, but sure did drive oil prices up fast for a week. Wink,
yeah.
wink.
We'll see. Let's see if they come down. All right, so those are some of the items that I think are biggies. And I mean, I'm willing to talk about any other item. I'm also willing to pull up brief exercise 11-6 and sort of talk through it, which is what somebody said. So I'll start on that. But if you have other questions, what I don't want to do is like spend an hour talking about things and people were like, I already knew that, right? Like, but I also don't want to, miss something if there's something you really specifically wanted to talk about or had questions about. So right now I'm going to be pulling up brief exercise 11-6 so we can talk about that concept, and you can be thinking of if there's other things that you want to have questions about. Mostly I want to help you be successful, whatever that means for you. That's the hard thing when people say, how should I study? And the answer is like, well, I don't know, because what's hard for one person isn't too bad for another. And that makes it tough. Let's see. You said that was on the homework 2, right? The 11-6?
Yeah.
Okay, let's take a look at it real quick.
I knew how to do everything besides after the dividend. Like I don't know how to get the common stock at the beginning for after dividend.
Sure. So let me read through it real quick. Stockholders' equity section of Pina Colada. Balance sheet consists of common stock, $8 par, 1,096,000, and retained earnings of 480,000. 10% stock dividend is declared when the market price per share is $17. Okay. So before, right, you were able to do common stock is 1,096.
Yeah.
And you were able to do the outstanding shares before because it tells us.
Yeah.
But after the dividend, so when we say there's a 10% stock dividend, we're just going to take the number of shares, 137,000 times 0.1, which it tells us right here is 13,700, and then add that to the 137,000. So that's the number of shares. It's just the number of shares after that stock dividend. But the harder part, I think, even than that, is figuring out the value of these of not the value, but the amount of stock we've issued. So if we issued 13,700 shares more at $8 par, then what we have to do is take 13,700 shares times $8. And that's going to be the dollar value at par of these shares we've issued, and add that to the amount before the dividend. Oops, I forgot the amount. That was dumb of me. Does that make sense, or does it not make sense?
Could you go over that again? Because I was just like, I didn't realize that there was like more shares that were issued. I just thought it was like a dividend. So
Yeah,
I was
no.
like, where's the problem again?
No, so I think maybe that's a really good point, especially as a review point, is to say, the difference between a cash dividend where you just pay out cash to your shareholders and a stock dividend is that with a stock dividend, you're actually giving out additional shares of the stock. So there's what you're doing is issuing more shares of stock. I'm going to bring up an Excel spreadsheet. I think it might make this easier to, if I can, there it is. So the first step is to figure out, well, how many shares, right? So here's what I had was 137,000. And so a 10% stock dividend means I'm going to add 10% more shares. So I can do 137,000 times 10%, which is 13,700 more shares. And then I'll add that to the 137,000. And I'll have 150,700 shares outstanding. And so that's also going to change all of these things. So like my common stock before was 1,096,000. But after, since I know common stock is always listed at the par value, if I had 13,700 more shares issued, I can say this is 13,700 shares times the par value, which was $8. So if I add those, this is the new value. So this is before and after. Did that follow or no?
No, but I'll figure it out.
It's okay. Like, I don't mind trying to explain it, from another angle or something if we need to.
So which numbers did you add together? So you had the common stock before the dividend. You
Right.
added that to what number?
I added that to, so I figured out how many more shares I issued
Yeah,
by taking the fact that there was 137,000 times 10% times
I
0.1.
got that.
Okay, so now I've issued 13,700 more shares, and then I multiplied that times the par value of $8.
Okay.
That's going to be the added value to my common stock account. So then I add what it was before plus the par value of the 13,700 shares issued. That gives
Okay.
me the par or the value of the common stock after the dividend.
All right, I got it.
That help? Okay.
Yeah.
And then for the paid in capital in excess of par value, there was nothing before, but now we're issuing these shares when the market price is $17. So I'm going to say I have the par value of, so I have to do 17 minus 8. That's going to be, so there'll be $9 of paid in capital in excess of par on each of these 13,700 shares that we're issuing. So let's say 13,700 shares times the $9 of additional paid in capital. That means capital over and above the par value of the stock. And that's how they get the 123,300.
Okay, I think I got it then.
Okay. Yeah, I think the stock dividends are confusing myself, honestly. I like them when I'm the investor and I get more shares of stock, but the accounting behind it can be a little scary at times. And then journalizing the issuance of stock. Who was it that had said that was something that they wanted to talk about? Was it you, Timothy? I'm trying to remember who said that.
It might have been Robert. He said he has a conference call for work beginning now. I don't know if he left or what.
Okay. Oh, let's see. Oh, I see that in the text now. Okay. So I'm not sure specifically what the, so here's some challenges or some issues I often see that when people are doing a journal entry for the issuance of stock. So the first thing is like recognizing that when stock is issued, there's often a par value and then some additional paid in capital over and above and beyond that. Let me see if one of these problems might give us an example of that. So I can, none of these are great. Okay, here we go. So here we have this corporation. They're organized January 1st, 2017. It's authorized to issue 19,000 shares, 5% $50 par value preferred stock, and 450,000 shares of no par common stock in the first, with a stated value of $1 per share, $1 per share. Remember that stated value and par value are essentially the same thing. It's confusing because they'll use these two different terms, but they're the same thing. And they're actually just an arbitrary value given to the stock in the company's corporate charter. I honestly think it's kind of defunct, but just a lot of states haven't ever changed their law, so it's still that way. So on January 10th, they issue 65,000 shares of common stock for cash at $4 per share. So recognizing then that what we're doing is we're saying, okay, my cash is going up, my common stock account is going up, and because the stock is being issued at a price above the par value, then my paid in capital in excess oh, sorry, stated value is what we're using here. Paid in capital in excess of stated value. That's going to happen. So each time we issue stock at a price over and above the stated value or par value, we're going to have both our common stock account increasing and our paid in capital in excess of stated value. So if I issued 65,000 shares times $4 per share, that'll be $260,000. And then the question is, how much of that goes into the common stock account and how much goes into the paid in capital in excess account? And since it's $1 per share is the stated value, I take $1 times the number of shares. And then the paid in capital in excess, I can either calculate that by taking the common stock minus the amount of cash, or I can say, if it was issued at $4 a share and the common value, the stated value was $1 per share, it'll be $3 per share in additional paid in capital. So 3 times the number of shares. So that's the sort of the process, at least in its simplest form, of issuing stock. Is this valuable? Should I go through a couple more of them and talk through them, or is this something everybody feels pretty comfortable with?
Did you do the preferred stock one?
Sure, yeah.
Walk through that one.
Yeah, so on March 1st, they issue 1,100 shares of preferred stock for cash at $54 per share. So again, I know my cash will go up. My preferred stock will go up. And then because if I look up here and I see that my preferred stock is $50 par, and I'm issuing it at 54, so I'm issuing it at a price above the par value. So I'm going to have some paid in capital in excess of par value. On the preferred stock. So again, I'll say, okay, 1,100 shares at $54 per share. So the amount of cash is going to be 1,100 times 0.54. Oops. No, not 0.54, just 54. $54, not 54 cents. So that's the amount of cash I'm going to get. The preferred stock account will go up by the par value of the stocks I'm issuing. So that's going to be 1,100 shares times $50 per share. And then the paid in capital in excess will just be the cash I got from issuing it minus the preferred stock amount, 4,400.
Is the paid in capital in excess considered a premium? Since it's worth more than the stated value.
Yeah, so it's not a premium in the sense of like a premium on a bond where you're gonna have to amortize that premium off.
Okay, that's where I'm getting.
Okay, that's why I'm like reluctant to use the term premium. Instead, it's just recognizing the market value for this stock was worth more than its par value at the time of issuance. So we want to always keep our stock account at its par value and then show any additional paid in capital separately. We're just keeping that separate. Any money that was over and above the par value.
Gotcha. Thanks for clearing that up.
Let's see. I think this is all just issuing. We could do more of these, or we can look at other things. What do you think?
I was struggling with like figuring out the gain or loss on redemption of a bond. For whatever reason, that would just throw me off. I don't know if I'm just not understanding the premium or discount associated with that, or
Yeah, I don't understand that either, and like the contractual rate and like selling above or below face value.
Sure. Okay. Yeah. That's back from chapter 10, right? So let's see if we can find a good example. Trying to remember. Let's see. Banknote. There's a bond, but it's not a great one. This one might be a good one. Not really, though. It doesn't have a gain or a loss on it. That's what I'm looking for, is one that has a good example of that.
I think it was in homework 1.
Was it? Okay. Sometimes I just feel like it's helpful if we have, you know, if there's a good one to sort of talk through how you work it out, and then it becomes like, I don't know, demystified or something. Let's see.
Just kidding, I might have been wrong.
Okay, well, let's, I just wish I had a good
I
example.
know on the additional study on like those practice tests, there was quite a few on that.
Okay. So let's
I could try to figure out what number it was.
see. So self
On
test
this, yeah, the self
chapter, no, chapter 10, right?
Yeah.
All right.
Let's see. I know number 7, 8, and 9, maybe, if you're on the right one. Maybe I'm on a different one. Because I know there was 2 of them on there.
I think it pulls from like a pool of questions. I'm not sure they're always the same. No, I think someone said they're always the same. Maybe it's the second self-test.
Yeah, I think it's the second one.
Okay. 7, 8, and 9. All right, bonds payable with a face value of 200,000 and a carrying value of 100. Those ones. So let's talk about these and see if it's helpful. So first of all, just generally speaking, you know, like bonds get issued typically at their face value, but sometimes because market interest rates have fluctuated in the time period between the bond issue being written up and the issuance, there can be a change, and so the bond gets sold at a premium or a discount. Okay, so first of all, there's a couple of terms that will help us with this, I think. So the first is what carrying value is, and carrying value is just the face value of the bond minus any discount or plus any premium. So that's what our carrying value is. So if we go up here to number 6, and it says the Kant Corporation retires its $100,000 face value bonds at 105 on January 1st, following the payment of interest. The carrying value of the bond at redemption is 103.75. Which of the following is part of the entry to record the bond redemption? So I'm going to look at this and I'm going to say, okay, when we redeem a bond, okay, remember, if our company issues a bond, it means we're borrowing money. So the redemption of a bond is going to involve the reduction of cash for us. And it's also going to involve our bond payable going away, and then either a discount or a premium on the bond payable also going away. So if I retire a bond at 105 and it's $100,000 bond, that means I'm going to do $100,000 times 1.05. So I'm going to be paying $105,000 in cash to pay off this bond. That's what it means to retire a bond at 105. If I retired the bond at 100, it would mean I would be paying the face value of it in cash. So my cash is going to go down by 105,000. my bond payable is always going to be listed at its face value. And then because the carrying value of the bond is 103,745, remember carrying value means bond payable plus plus premium on bond payable or minus discount on bond payable. So in this case, if I have $100,000 face value bond and its carrying value is 103,745, it must have a premium on it at the time of this of 3,700 and 45. Sorry, I did that my number wrong. So just if your carrying value is above your face value, it means you have a premium on your bond. Okay. And if your carrying value is below your premium, so below your face value, then it means you have a discount on the bond. Okay. So we have to get rid of our premium on bond payable. Premium accounts are on the credit side, discounts are on the debit side. So in order to get rid of a credit of 3745, I'm going to have to debit that account. Okay, I can't spell or type or one of those two. Okay, so at this stage, what I've got to do is say, am I in balance? I've got 105,000 over here, and I've got 103,745 over here. So I'm not in balance. So I'm going to have to do at least one more debit to make this thing balance. And so that is either going to be a gain or a loss on the redemption. And the way I remember this is because I remember expenses are on the debit side and revenues are on the credit side. And so the way I remember this is to say, if I have to put it on the debit side to make this thing balance, that's going to be an expense. So that's going to be a loss. If I would have had to put it on the credit side to make it balance, I would say that's a gain. So that's how I remember. And so then it's just the amount that will make this whole thing balance, which is what? $1,255. All right, so there was a bunch of steps there that I had to go through. The first thing I had to do was just recognize how much, if I had a premium or a discount sitting out there on that bond, and then realize what I had to do to get rid of that premium or discount. And then the second thing I had to do is figure out the amount of my loss or gain. And so then I can look at this and say, okay, a credit of 3745 to loss of bond payable? No. A debit of 3745 to premium on bonds payable? Yes. That's the, whoops. So that's the one that I'm going to have to include here. A credit of 1255 to the gain? No. A debit of 5,000 to the premium? No. Was that helpful or was that just more confusing?
No, that was really helpful.
Let's look at the
Definitely
next.
helpful.
Can we look at number 9? I don't know.
Sure, I was going to go 6 through 9, but let me jump to 9.
Okay, perfect.
And then we can. All right, so here I have a $500,000 bond is retired at 101 1/4 when the unamortized premium is 4,500. Which of the following is one effect of recording to retirement? So again, I'm always going to say I've got bond payable, because whenever you retire a bond payable, what you have to do is get rid of your bond payable, okay? Which means your bond payable account needs to go down to 0. So if I have $500,000 bond, then the first thing I'm going to do is debit bond payable 500,000. And then it's retired at 101 1/4. So that'll tell me how much cash I'm paying out to retire it. I'll take 500,000, the face value, and multiply that by 1.125 or 1 1/4. Wait, sorry. 0.125. So that's the amount of cash I'll actually be getting, or not getting, paying out to retire this, 506,250. And then it says I have an unamortized premium of 4,500. So my premium account balance would be on the credit side. So to get rid of that premium, I have to debit the amount 4,500. So up here we had to calculate the amount of that premium. Down here it just tells us it's 4,500. And now the difference here is going to be the amount that I have to do. So I've got 506,250 and 504,500. So sometimes if I'm feeling lazy about the math, I'll just say this minus this minus this. And that'll tell me the amount of loss. And then again, I can go through it and be like, okay, so $1,750 loss. That's the one. Did that help?
Yeah, that's helpful. I appreciate that.
Want me to do 7 and 8 too, just to talk through it a couple more times? Yes.
Yeah, if no one else has any other questions, that'd be
please.
helpful.
Okay. 2 yeses and we go for it, right? I don't know. That seems all right. Bonds payable with a face value of 200,000 and a carrying value of 196,000. So here I'm going, okay, this one has a discount, right? Because the carrying value is less than the bond value. Are redeemed prior to maturity at 102. Which of the following will result? So I'll say, okay, to redeem my bond, first thing I do, I debit my bond payable account by the face value. And then I know how much cash I'm going to get. I'm getting, or not get, I'm going to pay, which is 102 or 102% of the face value. So 200,000 times 1.02. So they're going to pay 204,000 in cash. And then I know that I had, oh man, 7 here. Yeah. Had a carrying value of 196,000, which means it must have had a discount of 4,000. Okay. Take the face value minus the carrying value will give me the amount of discount still remaining. Now I'll figure out my gain or my loss. In this case, I'm going to have a loss of, looks like $8,000, which I just added up this side, which was 208,000. I had 200,000 here, so the difference was $8,000. And again, I know it's a loss because it's on the debit side. If I have to put a gain or a loss entry on the credit side, then that's going to be a gain. So bonds payable, which of the following? A loss on redemption of 4,000? No. A gain on redemption of 4? No. A loss of 8,000? Yes. And then number 8. Let's see, $500,000 bond is retired at 97 when the carrying value of the bond is 483,000. So these are similar, all similar problems. So again, I'm going to say, when I retire this bond, the first thing I'll do is I will debit the bond payable account for the face value of the bond, 500,000. I always skip down to cash because that's the second easiest thing for me to figure out. If it's retired at 97, I'll say 500,000 times 0.97. paying out $485,000 in cash. And then the carrying value of the bond is 483. So again, because the carrying value is less than the face value, that means there was a discount. And since discounts are carried on the debit side to when I dispose of this bond or get rid of this bond, I'll have to credit for that discount. So 483, 500,000 minus 43 is 17,000. And then I have to figure out if I have a gain or a loss. It looks like I'm going to have a loss again. I think they're teaching you that bonds always lose. That's not true, by the way, but they had 4 in a row where it was a loss. Again, I could just find this amount by saying this plus this minus this, and that will be our loss on redemption. And so $2,000 loss is what we took on that one. Okay, other maybe questions that cropped up as we went through that, or just other questions?
On the required study, it brought up a bit about like contractual rate. What the heck does that mean?
So contractual rate is another term for like the face rate, or the rate that the bond is going to pay. So like, let's see, none of these had to do with paying on the bond. So let's see. So right here, Sosa Corporation issued a 10-year bond, face value 400,000, and a contractual rate of interest of 6%. All that means is that's the rate that the bond will pay the bondholders based on 400,000. So it means that this bond will pay 400,000 times 0.06, $24,000 worth of interest per year. And the reason they call it the contractual rate is that's the rate that the bond issuer, the person borrowing the money, is guaranteeing or contracting to pay the bond holders, the people who are lending the money.
Okay.
Sometimes it'll be called the face rate, but that's just to differentiate from the market interest rate, which fluctuates. This is a set rate that is agreed upon.
Okay.
Does that help? Yeah, this whole chapter, I feel like they use a bunch of synonymous terms, like without telling you this is synonymous, and so you're left to be like, wait, is that something different, or is that? And every textbook I've ever used has had this same challenge of contractual rate, face rate, or they'll just call it the bond rate, things like that.
Do you want to solve that one that you were just looking at?
Sure. Which one was it? 6?
I think it was
4.
4. Yeah.
Yeah, there it is. Okay, so Sosa Corporation issued 10-year bonds with a face value 400,000 and a contractual rate of interest of 6% on July 1st. What is the total cost of borrowing for the Sosa Corporation? And I'm assuming that what that means is over its lifetime, right? So I'm going to say over a 10-year lifetime. So we know that it's going to pay interest we have principal times the rate times the time. I'm going to say 10 years. So the interest it's going to pay over its lifetime is the principal times the rate times the time, $240,000 in interest. I also know that we're issuing this thing at 99. What that means, when you issue a bond at 99, it means you're going to only collect 99% of the face value when you issue the bond. So when they loan this money, they're only gonna, or when they borrow this money, they're only gonna get $396,000, but they're going to have to pay back the full face value of 400,000. So we're gonna say the discount over the life of the bond is gonna be that $4,000. So the total cost of borrowing is going to be any interest they paid plus any discount. So it's going to be $244,000.
Okay, that makes sense.
And the opposite happens if a bond was issued at a premium. Like, let's say this bond was issued at 101, right? They still have the same interest because the face value times the contract or face rate is always how the interest is paid. But instead of a discount, they'd have a premium, which would get amortized over the life of the bond. So their total cost of borrowing would only be $236,000.
So with discounts, they end up having to pay back more. Is that
Mhm.
right?
Yeah, because when you issue a bond at a discount, it means you get less than the face value in cash for the bond, but then you still have to pay back the face value. So it ends up costing you the interest plus any discount that you have to, amortize over the life of the bond. With a premium, you get more cash up front.
Sure.
But in this case, if they'd issued it at 101, they would have got 404,000 in cash, but they only have to pay back 4,000, so it reduces their cost of borrowing by 4,000.
So as a person who is it the borrower who is it the purchaser who takes the bond is having to do the discount, or is it the company that's doing the discount?
Yeah, so it's the issuer, meaning the person borrowing the money, that what happens is so like if I say I'm gonna like borrow $100 million because I've got this massive construction project or something, I don't usually borrow the whole $100,000 all at once. Instead, what I do is I get this bond issue authorized, and then I say for phase one of construction, we're gonna need $30 million. So I issue $30 million of that bond. Then in the meantime, while we're building phase one of the construction project, the interest rates are fluctuating. So if interest rates fluctuate up, meaning all the new bonds getting issued in the meantime are paying a higher rate of interest, I'm not going to get anybody who's going to be a taker on lending me money at this lower rate of interest. So what I do is I issue, or not issue, but I sell my next grouping of bonds when I need the next grouping of money at a slight discount, so that the rate of return the investor gets is about the same as they would be getting at the market rate. And so as interest rates go down, my bond prices will go up, and then the other way around. So as interest rates go up, my bond prices go down. So it ends up costing me more to borrow than what that face interest rate is if I have to sell it as a discount, because the market rates have fluctuated, and I'm really the only change in the price of bonds has to do with fluctuating market rates of interest and my ability as the bond issuer to be able to get people to invest. They want to make a market rate of interest.
Okay, so if I'm thinking of this right, so if I'm wanting people, let's say the market is issuing bonds at 7.9%,
Mhm.
and I need people to buy my bonds, I would want to put it at like a 7.63 or something lower than that 7.9%. Is that what you're saying?
So no. So no, yeah. What happens is once I've got the bond issue approved, the face interest rate does not change. It stays the same. So because I can't change the interest rate, what I can do is sell this already existing bond to you at a lower price so that you will yield an amount equal to the market interest rate. So because as the investor, if I can buy it at a discount, maybe I invest $990, but I'm going to get back 1,000 at the end, and I'm going to get paid interest on the full 1,000. I'll be yielding better than the face rate of the bond. I'll be yielding an amount that's in line with what the market rate is. Also, though, if I were issuing a new bond right now and I could choose the interest rate to be competitive, I'd want to pay a higher rate. That's always, I mean, think about it. If you have to borrow money, what you're always trying to do is you want to get the money for the lowest interest rate for you, but that's competitive enough to attract the lender, right? So it's the same thing when you're setting a bond rate. Is you want it to be a price that's high enough that investors want to buy the bond, but low enough that you're not paying more interest than you have to.
Gotcha.
Just so you guys know, when I took my Series 7 exam to become a broker, this was like the very hardest hardest section for me. So it's not just you, it's hard for everybody. Like it's until and then I worked in the bond market for like 5 years after that, and I became pretty comfortable with it. But at the time, it was like really confusing. So don't feel bad if it feels confusing. It is a little confusing. Other questions, other things you want to look at?
I have a couple questions going back to chapter 11 when we're ready to move back to 11.
Sure.
If my cat will stay off me. There were just a couple of things. One that I emailed you that was super confusing, but I'm not sure if that'll even be, it doesn't seem to be on the like the review document about journalizing like the closing entries. So there was only just one little bullet thought in chapter 11 about it. So I don't even know if it's worth being concerned about the closing out the income summary and the dividends payable. I printed it.
Well, and what was weird about that question is it didn't use the term close on the one. It said something like, I forget what it said, but it said something like the journal entry for net income. And it's like, what does that even mean? Because even when we learned about closing, we didn't ever close it as net income. Instead, we closed revenue to income summary, and then expenses to income summary, and then closed the balance of income summary to retained earnings. And
it said journalize the transactions, include entries to close net income and dividends to retained earnings. But there was literally one sentence in chapter 11, and no, it didn't show how to do it or anything, which is why I was like, what even is this?
Right. And that, it's like, that's like a chapter 4 concept, the closing entries, which seems like a really long time ago. Right.
Yeah.
As far as it sticking in our brain. So, I mean, just a quick review of closing entries might not hurt anybody. Excuse me, which is,
Sorry.
Which is when we get down to the end of a period, our revenue accounts will have some credit balance, and our expense accounts will have some debit balance. And so if our revenue account has $100,000 and our expense account, all of our expense accounts together, let's say have $50,000, then to close that, what we would do is we would debit revenue. It has a credit balance, and then credit income summary, same amount, and then we would debit income summary and credit the expenses. Now those expenses would all be back to zero, and the revenue would be back to zero. But now we have a balance in our income summary account because we credited 100,000 and debited 50. So income summary is going to have a balance of a credit balance of 50,000. Income summary represents our net income because it has our revenues on one side and our expenses on the other. So after this, like I said, we'll have this balance of $50,000 on the credit side. So to close income summary, we would just debit income summary and then credit retained earnings. So,
and that all made sense to me, but it,
right, no,
I guess
agree
just
with
the way
you.
the homework was set up, I was like, it doesn't even give you all the space to do all the things that you're supposed to do to close that out.
Right, because it skipped this step. It skipped this and wanted
That
you
whole
to go.
part.
It wanted you to go
Just straight
right
from
to this.
right.
It's because
And I guess that's probably what did it. And
yeah,
by
it
then I was
gave
no
you net
longer.
income. Well, and what's
Okay.
dumb is like you don't do that in real life. Like, well, honestly, in real life, what you do is you say, like, the computer just does it. Like, but even then, like you don't ever close net income directly to retained earnings. Instead, you close, because from a process standpoint, what you're doing is returning all those revenue accounts to zero so they can start a new period, returning all those expense accounts to zero so they can start a new period. And then it's like, well, what do I close them to? It's some permanent account and it's retained earnings. So anyway,
Right. Yeah,
It's not a bad review because it's been a long time since we've had to think about it.
okay, yeah, that was so confusing because I was like, okay, there's literally skipping steps. I know they are. I'm not bananas. I know I'm remembering this. And then there was one that is on this review sheet that is be able to determine the total dollar amount of dividends that would go to the preferred stockholders and common stockholder. It was kind of confusing, just the way it was worded. So it's not a specific question,
Right.
just determining the total dollar amount of dividends that would go to preferred stockholders and common stockholders when both classes of stock exist in the company that declared some cash dividends. So I
Right.
probably am just confused by perhaps the way they're wording it.
Yeah, I'm trying to see if I can find a good example one that I can work out for you guys. Because I think I know, let's see. So a minute ago I was talking about, so 28 kind of.
And I'm
Okay,
sorry if you already explained this because I did come in late. I had to
Right.
work.
So no, so look at number 32 here that I have up on my screen. MBOT Corporation has 10,000 shares, 8%, $100 par value, cumulative preferred stock outstanding. No dividends were declared in 2012 or 2013. If MBOT wants to pay $375,000 of dividends in 2014, how much will common stockholders receive? So the first thing I have to figure out is like, is this cumulative preferred stock or not? And it tells us right here that it is. And what cumulative preferred stock means is it means I'm required to pay preferred stockholders for any dividends in arrears, meaning dividends that should have been paid in previous periods but weren't, before I can pay their current preferred dividends. And then I'm required to pay all preferred dividends before I can pay any common dividends. So I've identified that this is cumulative, which means that I'm going to have to pay these dividends from 2012 and 2013 first. So I'm going to say preferred dividends, from 2012. And then preferred dividends, 2013. It doesn't like that. And then whatever's left over can be paid as common dividends. So the first thing I have to do after I've discovered that these are cumulative, meaning I'm going to have to pay these back dividends, is figure out what my dividends per year is. And so 8% preferred stock means we're going to pay 8% of the par value as a dividend. Okay. So 8% of $100 is $8. So I'm going to say 10,000 shares times $8 per share is $80,000 in preferred dividends. So I have to pay the dividends in arrears, 2012, 2013, and then the regular dividends of 2014. So this is my total preferred dividend. And then whatever's left can go to the common shareholders. So our total dividend was 375,000. So my common dividend will be the total dividend minus the preferred. So this is how much dividend I'm actually going to pay out: 240,000 to the preferred shareholders and 135,000 to the common shareholders. And then the question was, how much will common shareholders receive? So it'll be 135.
Okay.
Did that help?
And you actually, yes, and you actually answered my next question was
Okay.
about the 8%, because I feel like the homework didn't actually do much with this kind of question. So I wasn't sure if that was even, like, I didn't really understand how to do anything with that, because I felt like, or maybe we did, and my brain was so mush that I don't remember it. But so thank you. That actually answered both my questions.
All right. Hey, I'm not a complete failure today. Only like a 50% failure today.
Not even at all.
Well, no, I showed up late for the meeting. So you were late and I forgot that it's an hour later in Idaho than it is in Arizona. And so I was coming in at 2
Well,
o'clock.
it worked out really great for me because
but not for
I
all the
didn't
people
get
who
out of
had to
work
wait.
until 4:30.
Like I said, if someone, it's like when I go to a doctor's office and they have me waiting out there, I just start getting madder and madder. I'm like, this guy's probably playing golf. He's probably, when he's like really probably just backed up on patients. But I'm like, I think the worst of him. So I was not playing golf, guys, just so you know.
He's talking is what he's doing. I've worked for a lot of doctors, and what they're doing is they're
Other questions? I know we're hitting a point where the brain's function starts to recede below the rear end's ability to stay in the seat because it's been so long. But I'm willing to go over other stuff. I see Timothy's got the double thumbs up. I'm assuming that's his wife, so that means he doesn't have any more questions.
Yeah, I'm all right. Thank you.
All right. Caitlin, I think you were another one who had asked to put this together. I don't want to leave you without.
It was mainly just the dividends that I had questions about, but
Okay.
I have it.
Okay, good.
And any tricks on how to remember these ratio things, because I never can remember them.
Oh
I don't
yeah,
have tricks.
on the homework it was those ratios. You posted a video about how to solve it, and I kept getting it wrong over and over. Let me figure out which homework it was.
Maybe my video is wrong.
Well, I got earnings per share wrong, and I thought I followed the Wiley Plus video exactly, and I watched that thing like 15 times, and I still got it wrong, and I was just like, well, either he's wrong or I'm dumb, so whatever. It's like not even 50, like 0.5. I don't even care. I was so mad at it. By the end of the night, I was done. So I don't know if they were wrong or I was wrong, but I was so over it by that point. I think it was like 11 o'clock at night. I was so done.
So it was question 11-2B. I think that was the second homework.
Yeah, that
Yeah,
sounds about right.
It was
Caitlin.
all the ratios at the end. Like I got all of them wrong.
Oh yeah, I was definitely over it by then, Caitlin.
Okay. Let's see. So here I've got, so it's part D, is that what you're talking about?
Mhm.
Yeah,
Yeah, okay. So in fact, I'll just bring these up because I think this is sometimes, I bet you wish you had this little button on yours.
Well, we do, but that's after we get it wrong and we don't get any more chances.
Well, and on chapter 11, they didn't have it, right?
No, they had it, but after we don't get any more chances, they let us see what we did wrong.
They
Yeah.
didn't even have any videos for chapter 11.
No,
None.
Chapter 11 was, anyway. So
You
let's
had
talk
to
about,
go find them.
so let me go back to, where is that at? I just had it open. All right.
Rude.
Oh, why is it being so dumb? Because it's Wiley Plus, that's why.
That's right.
That should
He
be like
hates
there should be their new tagline. Wiley, we suck. Or I don't know. Sorry, this is a church. Okay. Things don't suck in the church. They stink.
But technically, this isn't in the church. This is they.
That's
They
right.
did pay for it. BYU paid for it, but
Right. So
they
we have a
didn't know.
payout ratio, okay, which is our dividends that we're paying divided by our net income. Okay.
There it is. Yeah.
So the dividends that we paid, 124,500 divided by our net income, which here's that income summary one, 275,600. So that one, I'm not, without knowing what I did on the video, like right now, Caitlin, or if I'm not sure where that one's at.
Yeah, I don't know either. I have no idea what I'm doing.
Earnings per share is going to be our earnings, which is our net income, but then we're going to subtract out our common dividends. So this company, you see they had a preferred dividend, and then they had a common dividend as well. So for earnings per share, it's just the net income minus the minus the preferred dividends. Is that what I said before? It's minus net income minus preferred dividends. So I would
Do
take
you
my
have
net
to
income.
subtract treasury stock or anything, or was that for the next one?
That's for the next part of it. But so just for the top
Okay.
part, we have to figure out what so it's return on so tricks for remembering it. I remember return means the same thing as like profit or net income. Okay. But then of course it's the return, it's the net income minus the preferred dividends. So I'd have to go back up here and look, I'll be like, okay, how much was the dividend on my preferred stock? It was 18,000. My net income was given to me right here at 275,600. So the numerator of the return on stockholders' equity is going to be the net income 275,600 minus 18,000. And then the denominator is the common stockholders' equity, which we found that, let's see, where's all the info given to me? By taking the value of our common stock plus our paid in capital in excess of common stock. So it's just the common, okay, it's the common stockholders' equity, plus the retained earnings, minus any treasury stock. That one wasn't too bad, but then we have to add that together with our common stockholders' equity at the end of the period, which is hard because we have to like figure it all out from all of this. So it's this really complicated process of saying, okay, so now I'm going to have an additional, well, maybe I should work it out instead of just trying to talk through it. It's kind of big. So my common stockholders' equity at the beginning of the period is going to be my common stock, my paid in capital in excess of par on the common, retained earnings less treasury stock. So at the beginning of the period, I'm just going to pull that off of here and say common stock was $1 million. There we go. Paid in capital in excess of stated value on the common stock, 480,000. Retained earnings, 686, minus treasury stock. So that's at the beginning of the period. And then at the end of the period, now I've got to go through all this and be like, okay, when I issued 5,000 shares of common stock for $30,000, and this is $4 stated value, that would have increased 5,000 shares times $4. It would have increased my common stock by 20,000. Oh, wait, sorry, I typed that. This should just be common stock. And my additional paid in capital in excess of par by another 10,000, right? Because it gone up by $30,000, $4 per share, which was the stated value plus another $1 per share. No, wait, is that right? 5,000 shares for $30,000. That's $6,000 per share. So that's right, $10,000. Okay. I think I'm confusing you more as I work through this. Is that true?
I'm already pretty confused, so you're not doing too much damage now.
Let's see. We purchased 1,000 additional shares of treasury stock. So at $9 per share, so our treasury stock's going to go down by another 9,000. A cash dividend on preferred stock's not going to affect our common stockholders. Paid the dividend there, and then declared a 50-cent per share cash dividend to common stockholders. And so if we look down here, that's 124.5. So paying a dividend reduces our retained earnings. But then we had a net income of 275,600. So that's going to increase our retained earnings. Telling you, it's a really big convoluted problem. So these would be the changes to each of these accounts from all of these transactions. An increase to our common stock account of 20,000, an increase to our paid in capital in excess of par of 10,000, an increase to our retained earnings of 151,100, and a decrease to treasury stock of another 9,000. So it's quite a process they're asking us to go through to figure out the new balance at the end of the period. And then we need to find the average by taking the beginning of the period plus the end of the period divided by 2. So that gives us the denominator. Remember, we started way back at the beginning with the numerator was our net income minus our preferred dividends divided by that, and that's what's going to give us our earnings per share. I'm not sure I helped you at all with that because it was such a convoluted, it would be the sort of thing that I would much rather in real life sit down with you side by side, have you with the pencil in your hand and me sort of walking you through doing it. Because
As long as there's not too many questions on the exam, I'll just get them wrong. I can afford it.
So recognize that. So I don't think you're going to have something this in depth on the exam, but it might tell you find the earnings per share, and it might tell you what the net income was, what the preferred dividends were, and then it might tell you what the number of shares outstanding at the beginning of the period and the number of shares outstanding at the end of the period are. And so they would at least want you to know that you would take net income minus preferred dividends divided by the number of shares at the beginning of the period plus the number of shares at the end of the period divided by 2, or the average number of shares. So if you know that much, you'll probably be fine, because
Okay, yeah.
this one, I really feel like they were really making you really extend the idea out there and have to calculate all of this stuff, which doesn't mean it's a bad problem, but it
was bad.
was
Yes, let's call it what it was. It was evil.
it was the fruit of the devil, right?
Yes.
Something like that. Anyway, and then return on common stockholders equity is like unto it, also evil. I'll show you.
Mhm.
Where it just has the net income minus the preferred dividends, but then you divide it by the average stockholders equity, which again involves figuring, it gives you what it was at the beginning, but then at the end you've got to like do this all of those changes. So again, if you just know that it's net income minus preferred dividends divided by beginning stockholders equity plus ending stockholders equity divided by 2, that would be enough for the exam.
Okay, yeah, that's fine then.
I'm sorry.
I wish they'd let us just have one note, and I just write the ratios down. That's all I need. I think I can wing the rest, but the ratios just kill me every time.
I wish there was world peace and no ships being stuck in the Suez Canal.
I don't even care about all that. I just want the ratios.
I just
on
gotta
my,
pass this test, man. Like,
that's all I
yeah.
care about right now.
So Adam, I see your picture has like Old Faithful in the background. I have a video at Old Faithful where we're watching it erupt, and then my teenage son says on the video, well, that was anticlimactic. So he was unimpressed.
Yeah, it can be that way sometimes.
The buffalo were pretty impressive though. So
Yeah, the buffalo are way cooler.
it's like, wait a minute. So I have to stand way back and just watch water shoot out of the ground. I thought it was going to be something more awesome. I thought it was pretty cool, but to a teenager, it was like, we drove all the way up here for this. All right, is that enough for one day? I hope it was useful. I again apologize for being like super duper late.
That's fine. I appreciate the help. So it was very
Yes.
helpful.
Very much.
Yes, thank you.
All right, well, good luck, and we'll see those of you who can be there on Thursday. And I'll post this as a video if anybody wants to refer back to anything in it. I'll post it in the announcements. Okay.
Yep.
Right.
Thank you.
All right. Thank you.
Thank you.
Bye-bye.